audible to all, right? We have stopped in the last class at this slide, pure discount bonds. So recall it again. So there are three types of bonds available in the market. The first type of bond is a bond with maturity. The second type of bond is a pure discount bond. And the third type of bond is a perpetual bond. The first type of bond has maturity period as well as coupon rate. And the second type of bond, pure discount bond, it has only maturity period. It doesn't have coupon rate. It does not pay interest every year until its maturity. And perpetual bond, it doesn't have a maturity period, but it has a coupon rate. It pays interest forever for the bondholder. Right? Pure discount bond do not carry an explicit rate of interest. Right? It doesn't have coupon rate. It provides for the payment of a lump sum amount at future date in the exchange for the current price of the bond. Right? Today you can buy the bond at the market price and you keep the bond for say 10 years, its maturity periods. And then you can resubmit the bond to the company, issuing entity, and you can claim your bond value. And the difference between the face value of the bond and its purchase price gives the return or YTM, Y2 maturity, yield to maturity to the investor, right? We will discuss in detail later when we calculate cost of capital, YTM, YTC, that sort of things. Now we will our focus on valuation of bond. Right. So this example focus on how to calculate YTM, right? Rate of interest, YTM. So it is not matter for you at now. Right. Now we move to the valuation of the bond, especially pure discount bond. Pure discount bonds are called deep discount bond. Deep discount bond because definitely we have to purchase the bond below its par value. So therefore, it called as a deep discount bond. A zero interest bond, it doesn't have any rate of interest. Or zero coupon bond. It has many names: deep discount bond, zero interest bond, zero coupon bond, pure discount bond, and so on. The market interest rate, also called market yield, right? Market interest rate, also called market yield, is used as a discount rate. So we have to take the market interest rate as cost of debt to find out its value. The value of a future discount bond equal the present value of the amount on maturity. You know that it doesn't provide any interest to the investor, bondholder, until its maturity. He has only one cash inflow. That time is at the time of maturity, right? So when we look at the formula to calculate normal bond, it has two things, no? Right. Here you can find, this is the formula to find out the value of bond with maturity, right? It has two things. The first one, first part. Can you see the mouse movement, mouse pointer movement in your screen?
Yes, sir.
All right. Right. It has two things. The first part is interest, right? Interest we receive. So we have to discount this value of future cash flow. That's interest. And it has another part is a maturity value, right? So since it's a pure discount bond, it doesn't have any interest payment. So therefore, we couldn't find this portion. in the formula. So we can observe only this part of the formula. Simply the value of the bond equal B naught equal Bn. So in value at maturity divided by 1 plus Kd at the time of maturity, right? It simplified the formula, right? The value of the bond is maturity value, right? Maturity value divided by 1 plus KD number of period. It's a present value. It's a PVIF, not PVIFA. It's not an annuity. The single payment. Therefore, we can't apply annuity. We have to apply PVIF conflict. Right. Consider IDBI bond with a face value of rupees 500,000 with a maturity of 30 years, right? The face value is 500,000 with the maturity value is 30 years, maturity period of 30 years. Suppose the current market yield on similar bond is 9%. So we can take this 9% as cost of debt. The value of IDBI pure discount bond today is, you know that uh, at the time of maturity, you can redeem 500,000 from the issuing entity, right? The cost of debt is 0.9%. So therefore 1 plus KD, 1 plus 0.9, that is 1.09. So number of period maturity after 30 years. So therefore 500 divided by PVIF equal 37,685.53. This is the actual value. It's implicit value, right? Real value of the bond, right? Do you want any calculations in Excel? I think you don't know. You don't want, right? Now we will move to the next third type of bond, a perpetual bond. As I told you earlier, it doesn't have a maturity period. Once you have purchased this bond, you are entitled to get uh, interest until you die, right? Perpetual bond until the company alive, right? Perpetual bond, called consols consoles, has an indefinitive life, and therefore it has no maturity value. Perpetual bonds or debentures are rarely found in practice. So in practice, in the real world scenario, we couldn't find this kind of a bond. It's not common, right? Where we can find very rarely, right? Example, right? So in the formula, you couldn't find the second part, right? That is maturity value. You couldn't find maturity value, right? You can find the first part. There will be a cash flows. There will be a cash flows every year or every defined period interval, and you have to convert that cash flows interest. You have to convert the cash flows into present value. So that's why you can use uh, PVIF. Anyhow, it doesn't have maturity. You can simplify this formula, right, like this: value of the bond equal in interest over KD, not 1 plus, right? Not 1 plus. So I can explain you how this formula has derived using uh, and geometric, not geometric, uh, multiplier, geometric progression. right? So it's, I think you have studied in detail in the first year business mathematics, right? It is not in our bound, not in our scopes, and therefore we leave it that. So our focus will be on the calculations, application of formulas, right? We no need to give attention how the formula has developed. Suppose that a 10%, suppose that a 10% 1000 rupees bond will pay as 100 annual interest into perpetually. What would be its value of the bond if market yield or the interest rate were 15%? So what is the coupon rate here? What's the coupon rate of this bond? Coupon rate of this bond, how much? Coupon rate 1000. No, no, no. Coupon rate 1000. No, 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 no. Yes. Who says? MRKT Silva. 10%. Coupon rate is 10%. And cost of debt? How much cost of debt? 15%. Yes, KD is 15%. Very good. And what is its face value? How much its face value? Good. Yeah. Then how much its maturity value? Maturity value? Maturity value, how much? No, it doesn't have any maturity value. It doesn't have any maturity. This type of bond, it doesn't have any maturity period, right? It's perpetual. Indefinitely, we can receive interest, right? So therefore, we couldn't find a maturity value as well as maturity period. Therefore, we have to drop the second part of the formula, right? At a time, how much we can receive as interest? How much we can receive interest from that bond? Dilan Madhusanga, tell me, at a time, how much we can receive as interest in a period? 100. Yes, good. Yeah, right. Everybody of my students have got the idea. Right, good. Now the value of the bond is determined as follows. Interest, at a time we can get interest 100 rupees. 100 rupees. Since it is a perpetual bond, we have to apply KD, not 1 plus KD. So KD here is 0.15. Therefore, uh, the value of the bond is 667. My next question is, does this bond a premium bond or discounted bond? Premium or discounted bond? No, no, it's not a premium bond. It's not a premium. It's not a premium bond. It's a discounted bond. Here its face value is 1000, but the implicit price is less than its par value. So therefore, and also its market price also should be less than 1000, because at the market the banks pays 15%, but the bond pays 10. Therefore, the demand for this bond will be reduced, declined. Therefore, the market price also will be go down, right? Right. And yeah, the bond value and changes in interest rate. So there's a relationship between the value of the bond and interest rate. Right? You have to compare the coupon rate as well as KD, right? Coupon rate and KD. If coupon rate is higher than KD, KD mean interest rate. So the bond will be premium or discounted. Say for example, coupon rate is 12%, cost of interest rate in the market is 10%. Now the bond will be treated as premium or discounted bond. Premium or discounted bond. Right? The value of the bond declines as market interest rate discounted increases, right? And the value of 10-year 12% 1,000 bond for the market interest rate ranging from 0% to 30% is down in the figure. So it's on in the figure right here. So par value, uh, bond value is 1,000. If interest rate is 0, right, and KD is 0, the value will be 1,000. When interest rate increases, the value of the bond will be reduces, right? Downward slope. Right. Maturity, bond maturity and interest rate risk. Maturity and interest rate risk. So I ask one question from all of you. Which there are two types of bond. One bond A, right? It has 1 year maturity. Bond B, it is 10 years of maturity. So which bond, A or B, has high risk? Bond A or bond B? Assume that friend A, he asked some amount of money, and he promised that he will give back that money in 1 week, right? And friend B come and ask you the same amount of money, and he promise you, I will give this money after 5 years. So which friend is more riskier? Yes, definitely B, right? Everything will be changed in the long period of time. So therefore, risk is high. Risk is high. Therefore, when risk is high, investors will expect a high return to bear that risk. The intensity of interest rate risk would be higher on bonds with long maturities than bonds with short maturities. The differential value response to interest rate changes between short and long-term bonds will always be true. Thus, two bonds of same quality in terms of risk of default risk, right, collapsed, bankruptcy, right, default risk, would have different exposure to interest rate. Right? There are two companies, two bonds, bond A, bond B. Both companies are in same credit rating, right? And one company issued a 1 year bond, another company issued 10 years bond. The expected interest rate is different, right? So for bond A, they require less interest than uh, bond B, right? Yeah, you can see the value of the bond at discount rate. The horizontal axis displays discount rate and vertical axis gives the value. Okay, there are three types of value. So this mark, why 5 years bond, right? When discount rate increases here, so value is always higher than the 10 years bond, right? 5 years bond value is all the times is higher than 10 years bond, and 10 years bond value of the 10 years bond is higher than perpetual bond. Bond duration and interest rate sensitivity. How sensitive to the rate of interest and its duration be. The longer the maturity of bond, the higher will be its sensitivity to the interest rate changes. Right? For the long maturity bond, having a high sensitivity to interest rate. Similarly, the price of bond with low coupon rate will be more sensitive to the rate interest rate changes. The price of bond with low coupon rate will be more sensitive to the interest rate changes. The bond's price sensitivity can be more accurately estimated by its duration. A bond's duration is measured as the weighted average of times to each cash flow, interest payment, or repayment of principal. So let us consider two bonds with 5 year maturity. So there are two bonds, both of them having 5 years of maturity. The 8.5% rate bond of 1000 rupees face value has a current market value is 954 and YTM of 10%. And 11.5% rate bond, 1000 rupees face value has a current market value is 1044 and its YTM is 10.6. 10.6%. Next, we find out the proportion of the present value of each flow to the value of the bond. The duration of the bond is calculated as weighted average of times to the proportion of the present value of the cash flow. The volatility, interest rate sensitivity. The interest rate sensitivity is called as volatility of a bond is given by its duration, YTM, right? The volatility is measured based on their YTM, the duration in YTM. A bond's volatility referred to as its modified duration is given as follows. Volatility of bond equal duration over 1 plus YTM. The volatility of 8.5% and 11.5% bonds are as follows. So according to the previous example, there are two types of bond. The first bond has a coupon rate is 8.5 and its YTM is 10%. And second bond is coupon rate is 11.5% and its uh, uh, YTM is 10.6. So let us calculate the volatility of the bond. First bond is 4.252. That's what it's a PVIF, right? PVIF, PVIFA at 8.5% and divided by 1 plus KD. So duration of the bond is 3.87. And for second bond, we have to calculate the PVIFA at 11.5% and it's 4.086 divided by 1 plus KD. right? It's not much. Um, right. The term structure of interest rates, the yield curve, right? Yield curve mean, so it shows the relationship between the yield of interest, yield, right? Yield mean return, and its maturity value, right? Its maturity value. So if we draw a line with relation to yield and the maturity period, this line is called as yield curve. The yield curve shows the relationship between the yield to maturity of bonds and their maturities. It also called as term structure of interest rate. Term structure of interest rate. The yield curve of Government of India bond is given in this picture. The upward slope curve implies that the long term yield are higher than short term yield, right? This is normally shape of yield curve, which is generally verified by historical evidence, right? Upward slope mean uh, when for the long term bonds, right? Its upward sloping yield curve implies that the long term yields are higher than the short term yields. So there are two. So two options. You have bond A and bond B. So bond A has a short period of time, and bond B is a long period of time. So which curve will be upward slopes? So definitely P is because it's a long-term bond. Many economies in high inflation period have witnessed the short-term yield being higher than the long-term yield. The inverted yield curves result when short-term rates are higher than the long-term. During the interest rate during the high inflation rate, it is inverted. Inverted mean so normally the term structure is upward slope. During the inflation period, the curve will be downward slope. Expectation theory. The theory is behind the term structure of the bond. The first theory is expectation theory. The investors are having some sort of expectations on the bond, about the bond market. The expectation theory support the upward slope yield curve, since investors always expect a short-term rates. So always expect the short-term rates to the increase in the future. This implies that the long-term rate will be higher than the short-term rates. So, but in present value terms, the return from investing in a long-term security will equal to the return from investing in a series of short-term security. You will study deeply once you have choose to follow higher studies in finance. I think this at this moment it's difficult to understand. The expectation theory assumes that capital markets are efficient, there are no transaction costs and so on. So leave it simply. Right. Liquidity premium. Liquidity premium means simply we can say the people are more likely to have keep money in this hand. Right? People are prefer to have the money quickly. That's why people are very interest to invest in short-term bonds rather than long-term bonds. If they invest in short-term bond, they can recover the money very quickly, and again they can reinvest to another investment. Right? Long-term bonds are more sensitive than price of short-term bonds to the changes in the market rate of interest. Hence, investors prefer short-term bonds to the long-term bonds. The investors will be compensated for this risk by offering high return of long term. Right? The people are prefer short term bonds Anyhow, to attract investors by the long-term bonds, they are giving higher rate of interest to their bond that comparatively the short-term bonds. The extra return, which is called liquidity premium. So they have sacrificed their liquidity. So therefore, the bond issuers give an additional return to the investors. That is called liquidity premium. So gives the yield curve its upward slope basis bias. A liquidity premium theory. The liquidity premium theory means that the rate on long-term bonds will be higher than the short-term bonds, right? The liquidity premium theory means that the rate on long-term bonds will be higher, right? Will be higher than short-term bonds. From a firm's point of view, the liquidity premium theory suggests that as the cost of short-term debt is less, the firm could minimize the cost of its borrowing by continuously refinancing its short-term debts rather taking long-term debt. Segmented market theory. So there are segments in the market. The segmented market theory assumes that the debt market is divided into several segments like product market based on maturity of debt. There are some people they are seeking for short-term investment, and another group of investors seeking a long-term investment. Right? In each segment, the yield of debt depends on demand and supply. Right? If there are a lot of investors who are seeking on short-term investment, the rate of invest for that investment is reduces because there are a lot of investors. Likewise, for the long-term investors. The investors' preference of each segment arises because they want to match the maturities of assets and liabilities to reduce the susceptibility of interest rate changes. And segment theory, the segmented market theory approach assumes investors do not shift from one maturity to another in their borrowing and lending activities. So they are not a switch from short term to long term, right? And therefore, the shift in yield are caused by changes in the demand and supply of the bond of different maturities. This is an assumption behind segmented market theory. And default risk and credit rating. Right? Default risk means the bond issuing entity fails to pay its principal amount. Right? If you give a loan to your friend, if your friend fails to repay that principal amount, because he default risk, right? There's a default risk. Default risk is a risk that a company will default on its promised obligation to bondholders. So the bond is an agreement between the bondholder, that is investors, and the issuing company. If the issuing company fails to satisfy the promised obligations of the bondholders, that time is called as default risk. Default premium. Default premium is the spread between the promised return on the corporate bond and the return on government bond with the same maturity. So when we compare the government and the company, who has more default risk, company or government? Right? So you have two options. Option A, you can invest your money by purchasing bond of government. Option B, you can purchase a bond issued by a private company or public company in the stock market. So when compare A and B, so which bond is more risk? A or B, government bond or company's bond? Please respond. Yeah, company bond, private company bonds. Or normally we cannot say private company, only corporations. Public companies can issue bonds. So when we compare government and company, high risk on company side. So therefore, uh, do we expect higher interest rate or not from the company to invest on that bonds? Do you expect the same rate of interest or you are expecting higher rate of interest to invest in company's bond? Yeah, you expect higher rate of interest from the company's bond because uh, the uncertainty, right? Sometimes the company may fail, default, bankruptcy. So this time you can't recover your money investment. Therefore, you are getting an extra return from them. So that's called default premium, right? So the default premium is the difference between the rate of interest paid by the government and the company's bond. Crisil's debenture rating, so it's a rating company. Now we will move to valuation of shares.